Welcome again to our recorded discussion. Our topic is capital gain tax on real property. So I am your discussant, Rebecca R. McKilling. Okay, so first let us classify the withholding tax. So we have two withholding tax, the final withholding tax and the creditable withholding tax. So final withholding tax is a kind of withholding tax which is prescribed on certain income payments and is not creditable against the income tax due of the taxpayer. It constitutes the full and final payment of income tax due of the taxpayer and the particular income subject to final withholding tax. Usually the passive income are subject for final withholding tax. Okay, so second is creditable withholding tax. It is withheld as source by customers or client, but it is not a final tax. It is an advanced tax deductible against the annual income tax due of the taxpayer. So example here is compensation, the tax withheld from income payment to individuals arising from employer-employee relationship. We have also the expanded withholding tax, a kind of withholding taxes which is prescribed on certain income payments and is creditable against the income tax due of the payee for the taxable quarter or per year in which particular income was earned. And we have also withholding tax on the government money payments. Okay, so now let's go to the withholding tax on government money payments, or the GMP. So usually government will withhold certain tax. So example, the value added tax and the percentage taxes. So the government will hold it. For value-added tax, it's with tax withheld by all government agencies before making any payment to VAT-registered suppliers on account of their purchase of goods and services. While for percentage taxes, these are tax withheld by all government agencies before making any payment to non-VAT-registered suppliers. Okay. Now, mm, why is it? What's the importance of withholding tax system? There are many importance of the withholding tax system. First, it is an effective tool in collection of taxes, and it encourages voluntary compliance. It reduces the cost of collection effort. It prevents delinquencies and revenue losses. It prevents dry spell in the fiscal conditions of the government by providing revenue all throughout the taxable year. Okay, so usually the one who withheld the tax are the one who will pay it to the BIR. Pero if the government withheld the tax, of course, it's already an income to the government. No need to give it to the BIR. But there are cases, no, they will give it to the BIRs, especially in accounting for government agencies. Okay, so it's still an income of the government. Next, persons required to withholding taxes. There are three persons required to withhold these taxes. So one is individual engaged in business or practice of profession. Second is non-individual, the corporations, associations, partnership, cooperatives, whether engaged in business or not. And we have also the government agencies and the instrumentalities such as the national government agencies, the government-owned or controlled corporation, the local government units, including the barangays. Okay, so now let's go to the capital gain tax on the sale of real property. The rule here is applicable to all individual taxpayers. So there are two requisites. First is real property must be a capital asset. So remember the classification of the capital asset and the ordinary asset in our previous video. And it must be located in the Philippines. Our formula is tax base, usually the selling price, the fair market value, or the zonal value, whichever is higher, multiply with the 6%. So that is your capital gain tax. Okay, how about for the government? Because the seller has the option, no? On their sale in the government, they have an option to pay 6% capital gain tax or just pay the basic tax. So it depends whether the company can minimize their tax. So it's part of the tax avoidance. Okay, so our example here is we have GCC company. This is a domestic stock corporation which is organized 2 years ago, engaged in buying vacant lot for the development and construction of housing units. Okay, so during the taxable year, the company purchased 2 hectares of vacant lot and developed 15 lots with constructed houses ready for disposal. The house and lot has a selling price of 2,500,000. Total cost is 1.8. The zonal value of the same lot is 2 million. And then the company spent 6 million for its operating expenses during the taxable year. The 15 lots with complete housing units were sold during the year as follows. There are 2 lots that is sold to the government, 13 lots to private individuals. Okay, so compute the tax under the following assumptions. First is 6% final tax. Second one is subject to basic tax. So take note, our selling price is 2,500,000. Our zonal value is 2 million. So whichever is higher, so meaning your base would be 2.5 if you are opting for 6% final tax. But if you are also opted to subject for basic tax, again, the government will help, no? So still 6% base pa rin doon sa whichever is higher. But if it's based on basic tax, you need to deduct the cost, which is 1/8, and then you will also must deduct the operating expenses. So take note, there are 2 lots to the government, 13 lots to private individuals. So let's look on the solution. Okay, so answer A, if the seller opted to 6% final tax. Answer B is if the seller opted for basic tax. Okay, so selling price, whichever is higher, so you use the 2,500,000. Okay, so times 2, that is 5 million, multiply with the 6%, that is your final tax. But if you are opted for basic tax, still you have your creditable withholding tax because the government will withhold, okay, 6% final tax rate. So the creditable withholding tax 300, the final tax is 300,000. So when you fill out your income tax return at the end of the year, so you have 13 lots which is sold to individual, 32,500. Of course, there is cost of sales 1/8. You have your operating expenses 6 million. So your net taxable is 3,100,000 times the tax rate 30%. So your income tax due is 930,000. Do not include already the sale to the government because this is already subject for final tax. But in the creditable withholding tax, you need to include it since this is also deducted, the creditable withholding. Okay, let's look on our income tax return. So if you have your sale, 13 lots from individual, that's 32,500 less cost of lots, 23,400,000. Your gross income now is 9,100,000 less the operating expenses, which is 6 million. So your net taxable income is 3,100,000. And you have your gain from sale of the government, which is 2,500,000, the selling price minus the cost, which is 1/8. So your gain on sale is 1,400,000. Your total gross income is 10,500,000 less operating expenses, the 6 million, and then that is your net taxable income is 4,500,000 times the tax rate 30%. Your income tax due is 1,350,000 less, of course, the creditable withholding tax 300,000. So your income tax due and payable is 1,050,000. So compare it if you're opted to 6% final tax. So much lesser yung income tax yun natin on the first choice rather on the second choice. Okay, so meaning you need to consider the choice A. Okay, next we have capital gains tax on shares. The rule here is applicable to all individual taxpayers. We have requisites. The share of stock sold, bartered, exchanged, or disposed must be in a domestic corporation. Take note, domestic corporation. And the transaction must be not through the stock exchange. So our formula here is this. Selling price less cost, less selling expenses. That is your net gain. Our rate is 15%. So this is our capital gain tax. Okay, so it's already simplified. So 15% out of the net gain. Okay, so our illustration is here. Mr. Jason Lim sold 15,000 ordinary shares, double company with a par value of 100 for 2,700,000 outside the local stock exchange. The shares were acquired by Mr. Jason Lim 2 years ago at a cost of 1/8. On the date of sale, the stock was selling 200 per share. So you will use the selling price, 200 per share times 15,000 shares. So our fair market value, higher than the selling price, of course, okay, is 3 million. You less your acquisition cost 1/8, so your gain on sale is 1,200,000 multiply with the tax rate, which is 15%. Your cap gain tax now is 180,000.